Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. U.S. markets whipsawed on conflicting signals as to whether President Trump was considering firing Fed Chair Jay Powell. And in a moment, we'll look at the Trump-Powell controversy with Rich Mullen. He is the CEO at Pallas Capital Advisors. But we begin this morning in the Asia Pacific. Joining me now is Ecaterina Bigos, CIO for Asia ex-Japan Core Investments at AXA Investment Managers. Ecaterina joining from our studios in Hong Kong. Thank you for making time to chat with me. So we had the monthly activity data for China earlier in the week, and the figures on industrial production beat forecast. I feel like this is a story of Chinese exports, maybe a little surprising in that I don't know how much it's a tariff story. How are you viewing the Chinese export economy right now?
Well, I mean, the Chinese export economy has done fairly well through this period of uncertainty around tariffs. First of all, I mean, there was a escalation and de-escalation, which I think was positive. But the key one was the redirection of the trade to ASEAN. And a lot of it then from ASEAN actually ended up to be in U.S. So I think redirection, so the de-escalation and the redirection has certainly provided easing on the impact that otherwise would have materialized if those didn't happen, right? So I think that's ultimately led to China still driving the growth through the external part, which is the exports.
So markets have been dealing with the reality of this U.S. tariff regime for a couple of months now. Are you surprised at how well economies and markets seem to be holding up?
I think that ultimately comes down to the point that I made earlier. I think the tariff delay, the front loading that we've seen from some of the U.S. As well and other markets, and the transshipment, as I said, through other economies that part of it ended in U.S. And just a general redirection for China into other markets has obviously provided a relief, but also has supported the growth for ASEAN economies. So that resilience and redirection that we've seen certainly has benefited the ASEAN economy. Then other theme that obviously has been present is the tech. So tech is still alive, and AI and development, which has led to increased demand for chips, which ASEAN, again, is part of that supply chain for chips, which has provided resilience. As we go into the second part of the year, I think that element related to tariff delay, the front loading and transshipment is going to wind down. But I think the tech theme is still going to be present. But a combination of that with probably deceleration of the onshore demand will probably have a weaker growth in the broader Asia, including China. So the broader view for China and Asia is a decelerating growth from here.
Well, I'm glad you mentioned the AI story because we've been getting indications that the American government has lifted certain restrictions, export restrictions to some types of AI chips to the Chinese market. I don't know if this indicates maybe a little bit of movement in terms of overall trade negotiations. But what do you think it means for the technology industry on the mainland?
I think it's positive, and we've seen already the sector taking that news in a very positive light. And I think it just gives China more room to advance in that technological sphere. And ultimately, I think is a positive as well, because U.S. is using this as a way of negotiating and getting outcome from China to deliver certain elements that are beneficial for the U.S. Again, the level of chips, or the high performance of the chips that are being allowed to be exported to China, they're not the highest performance level of chips, which again puts them still back and potentially advancing some sphere of that technological drive.
We heard recently from President Trump saying that he's likely to impose tariffs on pharmaceuticals as soon as the end of the month. Do you have a sense of the ramifications of a move like that?
Yeah, and I think some of the companies, particularly places like Singapore, stand to be impacted more. India to a certain degree, and I think it could have ramifications for China. I think the broader pharma and biotech sector just as a spillover. But I think the manufacturing per se, I think the Singapore and India, I say to a lesser degree, are likely to be more impacted. But certainly those sectorial tariffs we need to be prepared for. They will come. It's a question of how they're going to to get implemented, because the aim for the U.S. is to reshore some of that activity back home, and it's a strategic move, which is likely to evolve as we go into the second part of the year.
So Trump was also saying that he's recently reached a deal with Indonesia. Imported goods to the U.S. from Indonesia will face a 19% tariff. That seems maybe a little high relative to what the market may have been expecting. I think for Trump, what's more important is that U.S. exports moving into the Indonesian market will not be taxed. How would you evaluate this deal?
Look, I think ultimately is what is the perception of Indonesia? Did they get the good deal out of that? And the signs at the moment is that the Indonesian are relatively happy in how the deal was negotiated. And again, the previous tariffs would have been higher, so obviously it's a deceleration from that. And I think if I had to caveat and kind of broaden and canvas the broader trade negotiations, I think the market expectation is by and large that the tariffs that were voiced in the past were the kind of the upper limit of it, and the majority of the trading partners will get a lower rate, unless, of course, they try to impose tariff on the U.S. and again, escalation of tit for tat, which we've seen in case of China. But I think that's a positive sign, because again, the level is just lower to what it was voiced in the past.
I'm curious about the degree to which you're looking at the behavior of the dollar recently and guiding a lot of the decision making that you're having to confront right now. The dollar seems to have weakened a bit. I mean, we're strong over the last several days, but I think generally speaking, the trend has been to the weak side here. I mean, talk to me a little bit about how you understand that, particularly in light of what the Fed may be doing between now and the end of the year, and how that's influencing your decision making.
That's certainly, I mean, if you look at the beginning of the year and the expectations that many sell side and buy side put in place, certainly was dollar strengthening or dollar staying kind of range bound. The dynamics of the dollar, there's one point to highlight, it hasn't been uniform. It's not just a dollar weakness across the board, it's dollar weakness against various economies. We've seen that against the euro because, of course, we've seen as part of the tariffs escalation is the uncertainty of U.S. assets has been in the spotlight. So investors looked increasingly to diversify away from U.S. into other markets. And Europe, despite the ECB being ahead of the Fed, was a key beneficiary of that inflows. Also from Asia, what we've seen, a trend that we've seen again materializing this year, is that the hedging costs for dollar assets is still prohibitive relative to European assets. And we've seen Asian investors starting from hedge basis and diversification need basis to move into assets away from U.S. into Europe. Again, this is not a structural shift away from U.S., but this is a diversification drive that it is materializing.
When you look at South Asia versus the Northern Asian economies, and I'm thinking principally of Japan and South Korea, what's the contrast here?
Yeah, there are different dynamics that are driving those economies. I mean, there's some, ultimately tariffs is again impacting both economies. But one part that is challenging for Japan at the moment, as we've seen, is obviously policy or fiscal policy, which has brought a lot of attention from the investors, particularly on the 30-year JGBs, yields elevating higher. And again, what is Japan government conflicted with at the moment is an economy that is emerging out of kind of this stagnation, but is not yet thriving. It needs a support when the monetary policy needs to normalize and the fiscal policy does not have room. So they would have and they should use some element of support, but again, the room is limited. And we've seen, obviously, the elections that are coming up in Upper House on the 20th of July, kind of putting a lot of pressure on the JGBs because of that need to provide additional fiscal stimulus, which, again, the room is limited. When it comes to Korea, certainly the dynamics are related to tariffs, of course. Tech is part of the theme that has kept Korea resilient. And in Korea, what we had is a lot of political instability. And also, you can say, by and large, Korea has a lot more fiscal room and monetary room to support the economy. So slightly different dynamics, macro dynamics between the two economies.
Ecaterina, we'll leave it there. Thank you so very much. Ecaterina Bigos, CIO for Asia ex-Japan Core Investments at AXA Investment Managers, joining from our studios in Hong Kong here on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. President Trump is denying that he intends to fire Fed Chair Jay Powell. Late this morning, a White House official told us the president was likely to oust Powell soon. However, a short while later, President Trump said he has no plans to fire the Fed chair, and he said he was only discussing it in concept during a closed-door meeting with House Republicans. So when the dust settled, it seems as though the market was looking through this episode as political theater. Nonetheless, the race is on to find a successor to Powell. We have learned that NEC Director Kevin Hassett is an early favorite. Here is Bloomberg's Anne-Marie Hordern.
This is someone that he would be willing to cut rates, and he's telling people inside and outside the administration that he would like the job. The president also said yesterday, which I thought was really interesting, that Scott Bessent is still an option, but he's not his top option because he liked the job he's doing at Treasury. And we've been talking about that really for weeks. If the president was going to pull the Treasury secretary to move him over to the Fed, this would create almost another problem and a huge hole for the president.
That is Bloomberg's Anne-Marie Hordern in Washington. Let's get some reaction to all of this now from Rich Mullen. He is founding partner and CEO at Pallas Capital Advisors. Rich is on the line from just outside Boston. Thank you for making time to chat with me. What did you make of this whole episode today, Rich?
I think we've got some more gamemanship, quite frankly. I mean, we've seen this in the behavior out of Trump and the tariffs. I know that this is a far more dangerous game to be playing, but I really feel it's unlikely that Trump would fire the Fed chair. I mean, it would be extremely destabilizing to the markets. We saw that when the announcement was out. I think the S&P dropped 40 or 50 points. There was a spike in gold. And then on the denial, all that kind of reversed and seemed to, the market found a little solace in it. I think that, Trump is not unaware that this would be an extremely negative event for the markets. There's no secret that Trump follows the markets very, very closely. If he were, to fire the Fed chairman right now, I think you'd see gold soar. You'd see a massive spike in interest rates, and obviously it would affect the equity market. I really kind of feel like this is the game that he's playing here. Is we've seen the dollar depreciate considerably. It's kind of pick your adventure here, watching the markets respond to to the Trump administration's policy. We're seeing this depreciation in the dollar, and Trump administration's made no bones about it that the weaker dollar is something that they favor. Is really supportive of the country's industrial fabric. It encourages exports. It may offset some of the damage that the economy's feeling or potentially fearing, I should say, from the tariffs. But I think it's a remote situation that that Trump would fire the Fed President Powell right now, especially with 10 months left in his term.
I mentioned that a leading candidate to become the Fed chair when Powell's term is over next May is Kevin Hassett, one of the president's longest-serving economic aides. Are you concerned in a scenario such as that where maybe the Fed's independence would be at risk?
I am. I mean, I think, appointing a dovish successor, which I don't know whether you could label Hassett like that. You certainly could label him as perhaps a shadow of Trump's, impact on the Fed. But I think that would also have the same effect. It might not be as dramatic, but it would gradually continue to weaken the dollar. Bond prices would I think, yields would continue to rise, and certainly gold and would also assume its ascent in that scenario. So I think you really have to be careful. I think that the Fed's independence is paramount here. And I think you have to rely on the fact that this is a pro-business administration. And I think there's still a lot of gamesmanship here. So I think any sort of replacement to Powell has to be looked at, and I believe will be through that lens.
Nonetheless, if you look at, let's say, today's PPI report, which kind of reinforces the case for Fed rate cuts this year, I know that there's been some debate about the impact of tariffs and whether or not they will indeed be inflationary. But at this point where you sit, is there the risk maybe that the Fed is a little behind the curve?
I think it's a little early to tell. And I think what we need to see is some of this play out. I mean, we don't really know necessarily, in my opinion, with the start and stops of the tariffs, it's our opinion here that tariffs are, take typically 2 months or so to show up in inflation numbers. Not seeing that in spades, certainly, and then a quarter or two to show up in the economy. So you're right. I mean, yesterday's PPI was a bit benign and certainly, lower than expected. But the CPI came in a little bit hotter. At ex food and energy, it was actually a little bit cooler. So we're not seeing the effects of tariffs play out, certainly to the degree that people had expected in the inflation numbers. I've been looking at the jobs market. I've been kind of looking at, we all know that this economy is consumer driven, right? And we're starting to see a little bit of slack and softening in the jobs market. Still, though, you can contrast that with what the banks reported today. The consumer is alive and well, swiping away, if you will, at cards. Delinquencies and card balances are up, but delinquencies aren't. So there's a bit of a mosaic here of a lot of different moving parts, and I think it's a little early to draw some conclusions. Let's just talk about the market. While it's trading at fairly fully priced, if not rich valuations, you still have NVIDIA, a $4 trillion company growing at 69%. Somebody's spending money.
Yeah, most definitely. But you mentioned the banks. I'm glad you did, because some of this trading revenue data that we got today from the likes of Goldman Sachs, Bank of America, Morgan Stanley, that's very, very impressive performance.
Yeah, I mean, you could tie that right to volatility. If you think about the fact that we started the year in the market in the S&P 500, making all-time highs in February, followed by our Liberation Day pullback of 20+%, and then a subsequent bounce, and now sitting again at new highs. All that plays a great music to the traders on the desks. That volatility it really, I think, enhances and exacerbates trading revenues.
We also had the Fed's Beige Book survey today. Economic growth activity, according to the Fed, increased slightly between late May and early June, but a level of uncertainty remained elevated, and that is contributing to this ongoing caution on the part of businesses. We're talking about the tariff story here. Do you think it's an urgent matter now that the administration really needs to resolve these trade deals before things kind of progress further and maybe deteriorate confidence to a greater degree?
I really do. I mean, I started off the conversation by saying that I think there's a lot of gamesmanship going on here. I think, the art of the deal, right, is seemingly in play every single day with the current administration. But I do think that with this heightened level of uncertainty and corporations' failure to do any sort of long-range planning, I think the longer that goes on, I think it could have a kind of a deleterious effect going forward, and maybe even a negative feedback loop. I mean, listen, we're in the midst of earnings season right now, and I think we're going to get some clarity on that as to what these companies are seeing, what they're able to do, how they're able to project going forward, and maybe some insight as to how they're kind of preparing or planning for this uncertainty. Are
you focused more on what's going on in the States, or are you looking for opportunities offshore right now? Do you want to be diversified a little bit in foreign markets?
100%. We've been moving up our allocation to the international markets. The international markets, Europe in particular, have had a prolific gain, and you can attribute that to a bunch of different things, but certainly the effects of some of the trade policy or Trump trade policies, and also the mandate for increased defense spending that's going on over there. But I think you're seeing some of the trade policies and the Trump administration policies play out in Europe. I think Europe ex-Asia is up about 19%. So I mean, there's a market rally over there that we're attending to, certainly in our allocations. We don't think it's a blip. We think it's somewhat of a secular move as a result of some of these policies taking hold over there. So that is certainly, I think, the focus of our portfolios right now.
Okay, Rich, we'll leave it there. Very good. Thank you so much. Rich Mullen, he is founding partner, also the CEO at Pallas Capital Advisors, on the line from just outside Boston here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.